Picture this. You're sitting at a long wooden desk in a quiet office, pen in hand, staring at a stack of papers that feel heavier than they look. 30 years. That's what the loan officer just said with a reassuring smile. 30 years, but you can always refinance. 30 years, but most people move before that. 30 years, but it's good debt. You nod because this is what adults do. This is what responsible people do. You sign. In that moment, it doesn't feel like a cage. It feels like arrival. The keys slide across the table and everyone congratulates you. But no one really talks about what 30 years actually means. Not in math, in life. 30 years is longer than most careers last now, longer than many marriages survive, longer than entire industries remain dominant, yet we treat it like a standard subscription to stability. The 30-year mortgage has been normalized to the point where it barely raises eyebrows. It's packaged as safe, traditional, even wise. And in many cases, it can be. But the lie isn't that mortgages are evil. The lie is subtler. The lie is that 30 years is neutral, that it's just a financial tool with no psychological gravity attached. When you zoom in on the numbers, something interesting happens. In the early years of a traditional mortgage, a large portion of your payment doesn't even touch the principal. It feeds interest. You're paying for the privilege of time. Time feels abstract at closing, but it becomes concrete every month when the statement arrives. You begin to realize that the house isn't just something you bought, it's something you're slowly earning back from the bank. Ownership is delayed. Equity accumulates gradually, sometimes painfully so. Now zoom out from the math and look at behavior. When a fixed substantial payment anchors your life, your decisions begin orbiting around it. You measure career risks against it. You calculate family planning around it. You hesitate to move cities because selling involves friction and uncertainty. The mortgage becomes the silent partner in every major life choice, not visible in the room, but always present in the back of your mind. For previous generations, the 30-year structure aligned with stable employment and predictable income growth. Raises came steadily, pensions waited at the end of the road. Staying in one place wasn't unusual. But 2026 doesn't look like 1986. Careers pivot faster, remote work untethers geography, entire skill sets expire within a decade. Committing to a rigid, long-term financial structure in a fluid economic environment creates tension, not because it's impossible, but because it requires a level of stability that modern systems don't always provide. There's also a psychological illusion embedded in the monthly payment. If the payment feels affordable relative to your current salary, the loan feels manageable. But affordability is fragile when it consumes a significant share of your income. A shift in the job market, a health issue, an unexpected expense. Suddenly, the comfortable payment feels tight. The mortgage didn't change, your margin did, and margin is everything. The deeper lie isn't about interest rates or amortization schedules. It's about the narrative that a 30-year mortgage is automatically the smartest path to wealth. It can be a powerful tool. Leverage, when paired with appreciation and time, builds equity efficiently. But leverage also amplifies exposure. If home values stagnate or decline, if maintenance costs escalate, if property taxes rise, the guaranteed win becomes more complex. Real estate is not a savings account, it's a leveraged asset, and leverage is never neutral. Think about how we frame the commitment. We say it's just what you do. That phrase carries cultural weight. The 30-year mortgage became a rite of passage, almost immune to questioning. But when something becomes unquestioned tradition, it often escapes deeper evaluation. Does it fit your career path, your income volatility, your desire for mobility, your tolerance for risk? Those questions are rarely central at closing. The focus is on approval, not alignment. And yet, for some, the structure works beautifully. They buy within their means, in markets with long-term demand, with strong financial buffers. They stay put. They let time and appreciation compound quietly. For them, the 30-year mortgage isn't a lie. It's a ladder. The difference isn't the product. It's the margin and the context. The powerful realization comes when you separate the tool from the myth. The mortgage itself isn't deceptive. The myth is that it's universally optimal, universally safe, universally wise. The myth is that locking yourself into 30 decades of payments is the only responsible path to wealth. In reality, it's one path among many. Some will build wealth through business equity, through diversified investments, through geographic arbitrage, through lower fixed costs and higher flexibility. When you step back, the question shifts. It's no longer, is a 30-year mortgage good or bad? It's, what does 30 years mean for the life I want? 30 years of payments might be empowering if they buy you stability you value deeply, or they might feel constraining if they limit your ability to pivot, explore, or take calculated risks. The structure should serve your life, not define it. In 2026, the bold move isn't rejecting mortgages outright, it's refusing to accept them blindly. It's understanding that time is your most valuable asset, and any agreement that spans decades deserves scrutiny beyond monthly affordability. The real wealth isn't just in owning property, it's in owning your decisions. So maybe the 30-year mortgage lie isn't about deception, it's about default thinking. It's about accepting a long-term contract because it's common, not because it's consciously chosen. And once you see that, the power dynamic shifts. You stop asking whether you qualify for the loan and start asking whether the loan aligns with your version of freedom. Because at the end of the day, the goal was never just to pay off a house, it was to build a life that doesn't feel mortgaged to fear.